Hey everybody, Chuck Barone here. Tuesday, January the 3rd, 2023. Welcome to the new year. Boy, I'm a guy that loves the new year. I like the fresh start, the concept of a new beginning. Hopefully it's going to be a new beginning for the stock market and our politics and a better year in 2023 than we've had in any of the 2020s so far. But yay, new year, new everything. And we're going to have some changes coming up on the show that I think you guys are going to enjoy. We got a new backdrop. I'm just trying to figure out how to get all the damn wrinkles out of it. Nothing's easy, guys. Anyway, as always, we want to welcome you to the show. Thank you for your support. Welcome to the new year. We hope it's an exciting one for us. We're going to help you guys do everything we can do and have been doing to help you guys build wealth, get yourself above the crowd, doing the right things, living a life that's geared toward building wealth and doing some of the right things that'll make your life a whole lot easier to live and enjoy. In the markets today, well, the stock market was down small, a real nothing day in the markets. I think the markets are kind of looking for some direction right now. Earnings have been mixed. Apple, not a good day for their earnings today. They're having some issues with their supply chains in China. They're moving now, talking about moving production. Yay, Mexico. So the market's just not a lot to really move on. They're being driven pretty much daily by events, by news, by earnings, by whatever's moving these markets on a day-to-day basis. There's no real trend right now except down, and that's because of the most dominant thing on these markets, the Federal Reserve and rising rates. The bond market today, though, on the other hand, has a nice little rally. Yields falling, the 10-year dropping 8 basis points, sitting at 3.79%. The 2-year dropping just 2 basis points to 4.38%. So we still have that inversion there where the 2-year is higher than the 10-year. Usually when you have a yield curve, it kind of goes from the bottom left-hand corner diagonally up to the right top corner. This time around, we got it starting higher on the left side and dropping down to the right. Not a normal yield curve. The spread narrowing a little bit, but nonetheless still there, inversion, pointing to recession in 2023. The dollar today having a nice little rally, up over a point on the index, 104.67. The dollar kind of still the champ right now. I think people were just getting tired of it, selling off a little bit last week, rallying right back up today in its comfort zone. 104 to 105 right now has been where the trading range has been sitting. Metals today, in spite of a strong dollar, having a very good day. Gold up $14.70 per ounce, $1,840 and change. A nice number for gold. We've been talking about metals been wanting to rally. Here it is, guys. In spite of a strong dollar, metals rallying up nicely today. Silver basically having just a flat day, sitting at $24.06. But it's nice to see silver above $24. We'll see where the dollar goes. I think if the dollar comes back down a little tomorrow, you can have a little more rally in metals. I still think they got a ways to go, guys. So you guys in gold and silver, yay. Oil today down. Not a good day for the oil market. Down $3.11 for a barrel of West Texas Intermediate, settling at $77.16 per barrel. I made up my mind. I'm not even going to talk about natural gas anymore. It's just the stupidest market there is right now. If you're out there playing futures or options on futures, or you're in natural gas at all, good luck and be careful, guys, because that market's just bananas, and I'm done talking about it. As always, at the beginning of the week, we want to tell you guys what you can expect as far as important data coming, reports coming, that'll give us a little bit of a better idea of how we want to be investing, what's coming for the Federal Reserve. Today we got construction spending number down, builders not wanting to build. Everybody knows there's a correction coming in real estate. And then what's going to obviously get it turned back around once rates fall a little bit will be supply, because builders just aren't buying, aren't spending, aren't building. Tomorrow we'll get the manufacturing index, which I expect to be down, and the mortgage bankers index, which I also expect to be down. So tomorrow will not be a great day for economic news. On Thursday, the big day, we'll get the initial jobless claims. Now that's the one that's going to drive this market this week. The Federal Reserve is concerned about employment being too hot. It's causing this wage price spiral that's getting out of hand now. I think that number, if it comes in better than expected, is going to, even if it comes in as expected, they're not expecting any change. They're expecting 225,000. I think that that's a very strong number that tells us, guys, simply, the Fed is going to keep rates high until that number starts changing to their what they want it to be. Right now it's too hot. There's not enough unemployment. They want to get that number up. Also tomorrow we'll get trade deficit info. The U.S. trade deficit's going to be ugly. That's not going to be a pretty number either. On Friday we'll get factory orders showing manufacturing data, non-farm payrolls, and the new unemployment rate, which they're expecting to stay unchanged at 3.7%. So not a lot of data coming this week, but the employment data is the important stuff, guys. That's the stuff you want to pay attention to, because the stronger the employment data is, the stronger the Federal Reserve's response with higher rates for longer is going to be. And we'll explain a little bit more about that toward the end of the show. News you guys need to know today. Well, the slow motion real estate collapse is continuing. Prices coming down across the country. Here's the big news today. Institutional buyers, our private equity guys, the Blackstones, the BlackRocks, the Starwoods, the Pinnacles, the friggin' Carlyles, and all the rest of them have now slashed their purchase levels back by up to 90%. So basically, these are the guys who came in and perverted this market, made the prices go crazy, paying above appraised value for houses, just scooping up everything that was available. Now, well, they made the big mess. They don't want to stick around to help us clean it up. So they're basically out of the market right now, trying to lick their wounds as they're getting massive redemptions from people wanting out of those funds, cutting purchase levels by 90% or up to 90%. Let's see what that does about speeding up the price collapse in real estate that we all know is coming. Interesting news here. I was reading about this Fed reverse repo facility hitting a record of $2.55 trillion. Now, this is a tool, the Fed tool, that lenders use to park cash, reserves, stuff like that. These are companies, institutions, and banks that park their money with the Fed or private institutions, private players, who pay them interest on those overnight deposits. Well, right now the Fed's paying 4.30% on overnight deposits, beating out the private players, so all that money moving into the Fed for the higher rates, the repo facility, $2.55 trillion. Crazy. Fortune magazine, I was reading an article today, and I'm proud to say, Fortune magazine has come around and agrees with your host, yours truly, Chuck Barone, that the era of easy money is over. The article goes on to say they do not believe the Fed funds rate will be below 3% anytime during the next decade. They said that this easy money era that we've been through since pretty much the dot-com bust, but most especially since COVID, these 0% rates for too long have led to all kind of stupid perversions in the market, the rise of SPACs and cryptocurrencies and all these outside of the market unconventional things that are now all coming back down to earth. So as I told you guys before, get ready to earn a little bit more interest on your savings, on your money markets. If you're a bond buyer, you're a person that is investing for income, it's your turn, guys. It hasn't been there for 20 years. Going to start coming back now. And finally, to wrap things up today, guys, I just want to talk a little bit about this wage price spiral. It's starting to get really bad, and I'm sure this is the number one concern of all these Federal Reserve bankers right now. Now, what the wage price spiral is pretty simple. I've explained it many, many times. Prices are going up. Inflation is here. So workers demand more money so they can just stay even, need more money just to stay even. So the boss wants to keep them, wants to recruit new people, offers more money. At the same time, doesn't want to pay that money out of his own pocket, raises prices. So now you get wages going up, prices following. Wages, prices, wages. It creates a stair stepper that once you kind of get stuck in it, it's really, really, really difficult to get out of. And now what's happening, the phenomenon is growing. If you leave your job and you're taking new employment, you're averaging 8% wage gain just by making that change in your job. So what's happening is now businesses being aware that their people are going to start leaving to get that 8% extra income, because who wouldn't want that, are now starting to give their existing employees raises. It's a great time to ask for a raise right now, especially if you're a key employee at a company. So now, making that wage price spiral even worse, though, because now you got people that aren't changing jobs getting raises for basically retention raises is what they are. So now that's adding more pressure, because again, these businesses paying their helpers, their workers, their employees more money, they don't want to eat that cash from the bottom line, so they're going to be raising prices, and now you can see how this continues to go, right? Prices go up, workers demand more money, they get it, that follows, what follows that then is another price increase to pay those additional wages, and the spiral, once you get started, I can't wait to see the machinations the Fed's going to have to come up with to make it go away. Now, with all this doom and gloom about recession in 2023, well, bro, guys, we already been knowing this for at least the last 3 months, because I've been explaining to you, rate increases don't do anything to bring inflation down. The recession rate increases cause blows demand up, and that then brings prices down. So the idea that there's going to be a recession should not be a surprising one, because the Fed is going to continue to raise those interest rates until they get the recession they want. Anyway, guys, that's it for the day. As always, we want to thank you guys for your support. We really appreciate you. We've got all kind of new stuff coming up for the show this year. We're really excited about it to show you guys more. We know we've been kind of keeping it very basic here, and we're going to continue to do that. But we want to give you guys a little bit more tools to have that you can use to build more wealth, to make that wealth grow, to protect yourself from losses, and to do the right things to live a proper life as far as your financial life goes. That's it for the day, guys. We appreciate you as always. We'll be back again tomorrow. Tomorrow, of course, we'll be talking about manufacturing and mortgage bankers, so that'll be interesting. And who knows what the hell else this market's going to bring us. The Chinese have an old proverb that says, "May you live in interesting times." We've been blessed with that, because these times, if nothing else, are interesting. Anyway, we'll be back tomorrow, guys. We appreciate your support. As always, if you like what you're hearing, hit the like button. Ask your questions in the comments section. We'll be back tomorrow. Till then, take care. Thanks.